Hello, accredited IQ Nation. Welcome to the show of record for savvy investors like you, where in each and every episode, we help affluent investors to identify, evaluate, and execute on the finest investment opportunities the world has to offer. And today we do gloriously more of the same as we host noted analyst and expert in internet stocks, Mark Mahaney. Mark is the senior managing director and head of internet research at Evercore ISI. His pedigree on Wall Street begins back in 1998 when he began with Morgan Stanley, and he went on to work with other notable names like American Technology Research, Citibank, and RBC Capital Markets. And Mark's reputation is big and well-deserved, with Institutional Investor magazine having ranked him as a top internet analyst every year for the past 15 years, including 5 years at number one. He's also been ranked as the top stock picker, the number one guy by both the Financial Times and StarMine, and TipRanks has placed Mark in the top 1% of all Wall Street analysts in terms of single-year stock picking performance. But the achievement of the day, and the one from which you, my dear viewers, can benefit most, is Mark's new book called Nothing But Net, available right now on Amazon and wherever you buy your books. Mark, congratulations on your new book.
Thanks a ton, Brian.
Absolutely. Why did you write this book, and who's it for?
It's always been a bit of a dream of mine to go back through the last 25 years and try to pull out some lessons. My day-to-day job, you get so buried in the weeds, and I really enjoy those weeds. But I thought the book would give me a chance to step back. I've been lucky. I've lived through something really amazing in Wall Street history. The rise of the consumer internet sector, which was a boom, a bust, a bubble, and then a dramatic growth engine for not just the last couple of years, but really for the last decade or two. Phenomenal wealth creation. And I wanted to pull from that lessons that I had learned that I think any investor can draw from, both from the big successes and the big failures in the internet space. And at the end of the day, I was really trying to get at two things. One is, I think there's still a fair amount of skepticism about high growth, high multiple tech stocks. And I wanted to give investors a little bit more confidence to be able to wade in there and try to figure out, what opportunities are out there. But the other thing I wanted to do is kind of address what I thought is one of the biggest investor mistakes I've seen over the last quarter century when it comes to high growth tech stocks, which is to focus too much on trading the names rather than investing in them. And so what I tried to show, what I learned over time, is that if you can identify the highest quality assets and buy them when they're dislocated, you can have outstanding returns. You don't need to trade. You don't need to be a nimble trader just by investing in these names. And I saw that happen in spades through the internet boom of the last quarter century. Again, with a lot of volatility along the way. And I think it'll happen again with other sectors. So I tried to figure out what are the rules that people can apply so they can find the next Netflix, the next Amazon. So
that's very interesting to me. I found your book very informative and in a lot of places brutally honest about certainly the potential, but some of the risk as well, and some of your extraordinary experience and some of the ones that you've learned things from. But something that really jumped out to me was your comments about Peter Lynch, and he was obviously the star back in the 90s and that sort of thing. And Lynch is I remember reading his book and following his advice, and Lynch was all about looking for the great opportunity that was right before your eyes, and the only thing that matters was earnings. Is that still true?
So Peter Lynch was in part some of the impetus behind the book. I read his book, One Up on Wall Street. I think he wrote 3 or 4 books, and they were wonderful books. He actually wrote them started in 1980. That's how long. Yeah. That's 40 years ago. And I think a lot of people coming out of undergrad, high school, and starting off in investment clubs, it was pretty much a required book to read. But he also had some wonderful common sense wisdom in there about how to use your own judgment to find your own experiences to find stocks. The title of the book was One Up on Wall Street, i.e. how you as an average individual investor can do better than Wall Street, but simply because you're a consumer and you can figure out for yourself whether some of these products and services are good. my favorite story from his book was, you like the coffee, buy the stock. That's what got him into Dunkin' Donuts. Now, I'm no expert on Dunkin' Donuts coffee, but, I get the point. And I try to make that same point, except I brought it up 40 years. And the last version he wrote of the book was in 2000, where he talked about he called it the Millennium Edition. And my first reaction was, the Millennial Edition? No. He meant the Millennium Edition, as in year 2000.
Yeah.
And he talked about these newfangled internet stocks that are out there. And, he didn't, at that time, he probably made the right call. He thought that they were wildly overvalued and there probably wasn't much in there. Although he did, to his credit, say there's probably one or two winners in here, but you can wait for a while to figure out. And so here I am coming at this, 40 years after he originally published his book, and I'm trying to do the same thing. He talked about stocks at the time that were common, household names like Pep Boys and Dunkin' Donuts. I'm talking about what could we have learned from Netflix? Everybody subscribes to Netflix, almost everybody. Amazon, almost everybody purchases from Amazon. DoorDash, Grubhub. And by the way, I really try to focus on the winners and the losers because there are lessons from both. If you just, and I focus on my mistakes. I made, if you're in a stock picking business and you haven't made a mistake, well, you haven't been in a stock picking business because it's an odds business. So I really tried to draw the lessons. And I think a lot of what Peter said at the time was right. Now I go at it more from a growth tech perspective. So if the tagline from him was, earnings. My tagline is more revenue. Now, not because I'm disrespectful of earnings. I just think revenue and leading metrics, that's one of the biggest lessons I pulled away from Netflix. Those are the leading indicators for earnings. And I go through examples of companies that showed disastrous free cash flow outlooks and yet turned out to be wonderful stocks because the market over time correctly realized that revenue, those metrics would, in fact, translate into earnings and cash. And there's one tough trick, because if you want to focus on earnings, the truth of the matter is there's a lot of companies that go public today that don't have them. They go public early in stage. And so you can just wait. You're not required at all to buy profitless companies. But I think you could have made some dramatic returns buying profitless companies like Amazon, whose stock is up 180% since its IPO, Netflix up 45% since its IPO. Amazon was profitable about year 8. Netflix wasn't free cash flow positive until almost year 15. So I try to lay out some thoughts about how you handle those situations. If you think a company is really high quality, it's just early in investment mode, not generating earnings, how you can still invest in them if you ask the right questions.
So what are some of those questions? What should someone be asking to find the kind of stocks that you think are the right ones?
So let me step back then, Brian. The acronym, if you can remember one thing from the book, Nothing But Net, if you can remember one thing, I want you to think about DHQ. Now, not DQ, that's Dairy Queen. DHQ, dislocated high quality assets. And so what I tried to do in the book is describe, what's a high quality asset? One with a compelling value proposition, one with great product innovation, a company that addresses large TAMs or total addressable markets, and a company with a really good management team. You put that combination together, there's usually a financial tell from that combo. That financial tell is the ability of a company to generate 20% plus revenue growth, i.e. premium revenue growth, from scale, like from hundreds of millions and even billions in revenue. You find those high quality assets. That's what you want to invest in, but wait until they're dislocated. And what I have learned is that even the highest quality assets over the last decade, they all get dislocated at some point or another, either because management teams make a miss on a quarter, it's going to happen, or there's a market rollover, but use those as opportunities to add or buy, take your shot at and owning and investing in for a substantial period of time these high quality assets.
So dislocated means there's some sort of an anomaly that gives you a buying opportunity. Is that the size of it?
Yeah, that's right, Brian. I quantify it, but there's a lot of caveats. I usually look at a name that's off 20 to 30%. I think from a recent high, you have to use some judgment calls in this. Sure. If it had galloped up 100% and then corrected 20%, that may not be dislocated. But, stocks that are trading off 20 to 30%, or for those who look at PE ratios, price to earnings ratios, and then price to earnings to growth ratios, that was one of the big things in Peter Lynch's book way back then, was you find the companies that trade at pegs, PE to growth ratios less than 1, I would call that dislocated. So I use these examples. I mean, this wonderful acronym called FANG, Facebook, Amazon, Netflix, Google, all of those stocks. And those are the highest quality assets that I've seen in my 25 years. And maybe I've thrown one or two other names in there. And I'm not the only one. I mean, the market's put market caps on these names that clearly say that these are high quality assets. Right. But every one of those has had a correction between 20 and 45% at some point in the last 3 years. And so, yeah, when you find those dislocation opportunities, if you first identify the high quality assets and just be patient, because they're all going to get dislocated at one point or another. And sometimes it's just for market weakness reasons. That happened with Amazon in late 18. That's fine. You can step in on a major market weakness and look for the highest quality assets to buy.
Sure. So then, as I recall, your book is laid out basically in 10 different steps or big ideas, which made it pretty easy to follow, which is great. But here's my question to you: we had you mentioned when Peter Lynch came out with the Millennium Edition back in 2000, and he probably felt pretty vindicated from 2000 to 2014, 15, something like that, because it was a pretty bad time, pretty rough time. For the NASDAQ, I guess there were individual stocks that were doing great, but But here's the question: really, is this? You've got the FANG stocks, perfect example, performed beautifully, and kudos to you for having been a recommender of those for so long. But how do you know when to go the other way?
Yeah. Okay. Well, I mentioned earlier, Brian, that the idea I look for premium growth companies. And look, you can make plenty of money as a value investor in other names, or, that have rising dividends or that will issue dividends, buy aggressively purchase back shares. There's wonderful ways to grow earnings through taking out costs, shrinking the share base, et cetera. Sure. There are companies that do that. I tend to spend less time on those. I think I'll tell you this 20% rule I came up with. Now, other people have kind of used this. The tagline I like to use is, if I try to find companies that can pull a Google. That is, that they can grow at 20% plus off of scale for multiple years. Google did this. They hit 25 billion in revenue, rare air, 25 billion in revenue around 2010. And then for the next 10 years grew at 20% year over year. There are 3 companies in history that have done that: Google, Amazon, and Apple. So that's the positive side, but you're asking me to chase the negative. Well, the negative is when I see those stocks decelerate meaningfully below that 20% growth level. I mean, these companies come public. They usually come public with a lot of hype is a strong word, but there's usually a lot of expectation around them, especially they trade high multiples. Those things kind of come together. And then, with high growth rates. But if those growth rates quickly decelerate, that's usually a really big warning flag. Major decelerations in growth rate. And I'm talking about the revenue growth rate getting cut in half in like a 3 to 4 quarter period. That either tells you that the TAM, the total addressable market that they're addressing, may not be as large as the company thinks it is, or that the competitive risk is a lot steeper than the market thinks it is, or that the company has just been not as successful at product innovation as maybe was embedded in the stock price. So I'm a fundamentalist at the end of the day. And I've seen a lot of variations, volatility. I've seen stocks trade in and out of quarters. And one of my biggest warnings early on in the book is don't play quarters. There's long-term stocks move on fundamentals. Near-term, there's a lot of different factors. I've seen companies have blowout earnings and trade off. I've seen companies with subpar earnings, fundamental earnings, stuff that looks weak, revenue growth decelerations, margins declining, and they trade up. Because when you're doing quarterly earnings, you're getting into the fundamentals and the expectations game. And It's just, there's a certain type of trader who's very good at that. And I work with a lot of those clients. But I think for the average investor, I don't think it's worth getting into the expectations game. Instead, you just want to look for companies that have improved fundamentals and are likely to get bigger over time. And I generally have found, with very few exceptions, especially over the long term, give me a year or two, companies who get bigger in terms of revenue bases, profit pools, their profit margins, free cash flow earnings, they tend to go higher as stocks. They go, and then you look for those gap up opportunities if you can get them when they're dislocated. But I just like riding good fundamental stories. And I found that the market generally rewards that. And companies the other way that have sharply deteriorating fundamentals, sharply decelerating revenue growth, margins that get pressured in a relatively short period of time, those can dramatically underperform the market. So that's what I look for, those fundamental tell indicators to figure out how aggressive or how negative to be on a stock.
So you included a chart of 10 companies in your book that have already made it to the vaunted $1 billion net income range. Obviously, all the FANG stocks. But the statement that you made after that was the one that got my attention. You said that your guess is that another 10 will be added to that list over the next decade or so. So this kind of leads me to two questions. One of them is, can you put your finger on a guess as to what some of those might be? And number two, really more importantly, is that the right question to be asking if I'm trying to find those stocks is who will be the next $1 billion plus companies in net earnings? Or are you just looking are you looking primarily at 20% year over year net revenue increases?
I got you, Brian. Well, I tell you what, those $1 billion companies that are able to generate $1 billion in net income, usually companies that are pretty sizable.
Sure.
That's rare air in terms of earnings. And so, you find companies that can get up there, and if you can correctly predict those. So then I'll get back to, again, what's a high quality company? So you're looking for companies that, and I'm going to double click on each of these lessons, if you don't mind, Brian.
Sure.
So first, one of the things I talk about is, focus on the value prop, not the business model. I like to focus on companies that are really hyper-focused on customer satisfaction rather than on pleasing Wall Street, rather than on ramping up margins. The history of eBay versus Amazon or DoorDash versus Grubhub, these are all four of those are pretty much household names. I think they're a wonderful tell about this story. I'll just stick with Amazon versus eBay for now. I mean, eBay had the better business model, better gross margins, capital light business model, darling of Wall Street for 5 years. And I was a bull on that stock early on. I covered it at the time of its IPO. And Amazon was this, they had distribution centers, low gross margins. They weren't profitable, but Amazon's value proposition to consumers was so much more compelling, better price, selection, and convenience. And long-term, the company that had the better value prop, the customers, handily defeated a company with a better business model. The first decade of the commercial internet, eBay had as much as a 5x bigger market cap than Amazon. Today, Amazon's today market cap, Amazon's is 50x that of eBay. So that's one thing to hyper focus on. Secondly, I did mention these TAMs, total addressable markets. The ideal scenario, the package you want, companies that are addressing really large TAMs, like hundreds of billions in size, and have a small single-digit percentage share of that. That's the ideal combo. You don't always get that, but that's the ideal combo. But usually the bigger the market opportunity, because it just creates more opportunity for really elevated growth. Third is companies with great management teams, and that's a really hard thing to get out. Now, I have a bias for founder-led companies. At the end of the book, I line up the largest market cap companies in the world. They're pretty much all founder-led, or they were for a substantial period of time. And I go through the example of Amazon's one, Zillow's another one, and Facebook may be a good current example. Founders that lead their companies, they're more willing to take bold, aggressive, long-term bets, even at the sacrifice of short-term profits and stock prices, but they can create a lot more value long-term. So I like that, or people who prove to be real industry visionaries. I love the example of Netflix. We all know Netflix now. It was founded in 1997. The name's Netflix, which always kind of gave you the impression of some sort of streaming over the internet. Well, they didn't do streaming for the first 10 years as a company, because it would have taken you 4 hours to download the first 5 minutes of Terminator, back in 97. But what I respected is the fact that they had the vision, and then 10 years later, they actually executed on that. You rarely see, and that management team, that founder, especially Reed Hastings, I mean, he practically invented DVD by mail. Then he invented the business that destroyed DVD by mail. Like, that's a rare thing to see, that streaming. And then he also went in and created original content. So he's had like 2 or 3 very interesting business pivots. Anyway, that's the sort of thing I'm looking for in a management team, vision and founder-led companies. I talked about TAMs, compelling customer value propositions. And the last one of the four kind of things I'm looking for, last one is really good product innovation. And gets back to kind of the Peter Lynch principle. We're all consumers here, and you can go ahead and spend $10 a month. You could have, and decided whether or not Netflix was a really interesting value proposition or not. Was there really a lot of good, useful content in there? Was it personalized to you? Was it easy to stream on multiple devices? You can do the same thing with things like companies like DoorDash or retailers like Amazon. And then there'll be new ones that are coming up. Ride sharing companies, I think, are a very good example today. Uber and Lyft. Anybody can sign up and use Uber as a customer. You can also sign up and use Uber as a driver, and ask yourself, well, how good was that consumer value proposition? How else could you have gotten to where you wanted to go or needed to go? A taxi, public transportation, et cetera. And when I run these surveys on Uber, I find customer satisfaction is usually off the charts. And it's usually one of the wonderful things about high customer satisfaction businesses is they have pricing power. Netflix proved that. Spotify's proven that. I think Uber has proven that. Not too many companies have pricing. You only have pricing power if you offer something to consumers that's really compelling. So I love to see that in an example. And then, again, this is something, Brian, you and I and anybody else can try the service. And if they don't like it, they shouldn't invest in it. I've got a young son. My youngest son, who's in freshman in high school, and was asking me about, I want to do research. I want to pitch a stock to my investment committee, my fund investment committee at school. And I said, well, which company do you use a lot? Like, do you feel like you might know? And he said, DoorDash. And I said, I don't, and I actually don't have an investment. I do have an investment opinion on DoorDash now. It's a hold. But I said, look, the asset. And think about, like, if you like the service, why do you like the service, and how replicable do you think that is? Do you think a lot of people would like DoorDash as much as you do? And if you do, then start digging into the company. And anyway, I just think my simple point there is anybody can form an opinion about how good the value proposition is for many of these companies for usually relatively nominal amount of research dollars, $10 a month, a $15 food order.
Well, Mark, as I told you before we started, a whole lot of the folks who are subscribers to Accredited IQ magazine are really heavily oriented towards alternative assets like real estate and oil and gas and other kinds of opportunities like that, other asset classes like that. But folks, I do recommend that you take a serious look at Mark's book, Nothing But Net. It's certainly proven to be very informative to me, and I think it will be to you as well. So, Mark, again, congratulations.
Thank you, Brian.
It's a great work, and I wish you the very best with it.
Thank you very much, Brian, and thanks for the opportunity today.
Thank you.